आज का शो शुरू करते हैं। दिस इज गोना बी अमेजिंग। थैंक यू सो मच रोहित सर, थैंक यू सो मच वी सर, थैंक यू सो मच ब्रेकआउट चैट सर फॉर जॉइनिंग अस टुनाइट। मार्केट की बातें करेंगे, बहुत मजा आएगा, बहुत कुछ सीखने को मिलेगा एंड आई बीन लुकिंग फॉरवर्ड टू इट अ लॉट। So, I mean, I would introduce with, I would start with the introductions, but I think हमारे guests are amazing. Everybody is a fan. So, without any further ado, directly शुरू करते हैं. They do not need any introduction whatsoever. शुरू करते हैं सर। रोहित सर, आपसे जानना चाहूंगा, what is पहले एक broader market का overview maybe. What do you think is happening in the markets right now, and where are we headed? So I think कुछ time में correction आया था, but then there has been relief after relief has been happening. So is that correction over maybe, or is it just a rally of bear markets? What do you think, sir?
So my sense is that we are now almost 9 months into the declining phase from the high that we made in October, and into mid of June we had one of the most bearish conditions in terms of sentiment, which means that the setup was showing some data points which were the lowest since the pandemic, which is typically how you either end up getting to bear market lows, or you end up getting to points which are somewhere in between a bear market. But you do get significant bear market rallies from such extremes, because when everybody turns negative, the market does not respond accordingly, and it results in, whether we call it a short covering rally or some kind of a relief rally. And that's somewhat what we have here. I think this is the first. Although we've had a couple of sharp rebounds both in January and also into April, but those did not come from similar readings, which is why this one takes a slight more significance in that sense, that it comes from an extreme in sentiment that we've not seen since 2020 or probably previous bear markets. And so, so far, the assessment still remains that this is possibly a bear market rally that we are witnessing. And they're typically sharp. You get a 50 to 60% retracement in a couple of weeks' time. Usually 5 to 6 weeks. So we're already into the 5th week of this rebound, which leaves us with little in terms of time. And 1 week ahead of what will be probably an important event, because we hope that we get some insights into how policy is likely to unfold in the coming months ahead. Now, why that also is an important, event in terms of what you want to hear on the macro front, is because when you get a rebound like this, I said that it's from an extreme typically seen at the end of bear markets, and if that is true, then something on the macro needs to change, which has not happened as yet. And so I think the floor is probably divided into two when it comes to a US equity market view. There's the one camp which believes that the Fed is watching the wrong data points in terms of the lagged data from the job market, the labor market, which often has a slight delay in terms of really reflecting what is happening in the ground economy. And if they continue to look at that from an inflation standpoint, they might tighten too much or for too long, which will continue to slow the US economy. The fact being, and so here's where the other camp comes in, is that they believe that the economy is already slowed, and probably, like we all can see it in the data, the Fed can too. And they might at some point pivot, because given the high debt levels, they are not likely to raise rates beyond a point. And so they'll start giving, at least if not turning now, they'll give some indications of what the turning points could be. And that could sort of stabilize the markets. No, so this is a two-sided divided camp on how things may unfold. And in either scenario, I do see one possibility that you are going to see continued earnings weakness and a tightening market scenario, simply because it's not going to be a quick turnaround from quantitative tightening, and the impact of weak earnings and higher rates may continue at least into September or October. And so in that sense, there is a risk of one more potential sell off after this bear market rally, as we are calling it. But the depth and size or scale of that would really depend on the policy paths that we end up seeing ahead of us. So I think that's sort of the landscape we are in. So at the current juncture, we've already rallied 1,500 points from the bottom. Probably leaves room for another minimum 400-500 points, maximum maybe from 16,500, maybe 17,300. In a better case scenario, so it could typically overshoot 17,000 if things just continue to unfold, or it could simply get there and then gyrate up and down as you get the usual sectoral rotation. And so we'll end up watching that, I think, into the early part of August. But if we do see weakness develop again, then we'll look at the potential for another sell-off from there. That's, I think, the overall picture.
That's a very comprehensive and great analysis, sir. Thank you so much for that. I do have more questions for you, sir, especially the one particular question that I think you were one of the earliest people to kind of expect this rally when we were at the very in a very dark, if I may say so, in a very dark scenario. We were about to hit bottom, and you gave a rally call at that time. So I want to understand your strategy there. But before we go there, I would love to have a perspective from VVV, sir. So what do you think is happening in the markets right now, and what does your analysis say?
Yeah, so potentially it could be a bear market rally, or typically it could also be a start of a small. I mean, I don't think a big bull market could start now when the Fed is still behind the rates. There's a lot of in general, whenever a stable rally from the lows have happened is when there was a statement right from the Fed, a verbal statement from the Fed. If you look at all the bottoms that has happened in the past, they've always happened when the Fed has always, given a proper statement out there that they're going to either stop the rate hikes or, possibly will stop soon, but nothing has come yet. I think 26th is the Fed meeting. So let's see what happens then. But then you could see in general, when we talk about leaders of the stock market and laggards of the stock market, in general, leaders top way before the market tops, and similarly, leaders bottom before the market bottoms. And in general, there are generally smaller number of leaders and larger number of laggards. So on the average, the leaders and the laggards are called the market. So in general, when there are smaller number of leaders, you'll definitely have the market respond later, because the leaders would have started moving, the laggards will still will keep moving down or sideways. So the market might take a little bit of time to tell us whether we've bottomed or not. But I think a perspective that everybody should keep is to see number of stock setups that are coming in your screen, number of net highs that the market is hitting. So if you find a lot of stocks breaking out of sound bases and moving to new highs, I think irrespective of whether it's a bear market rally or a new bull market, which see, every bull market is, every bull market is is also a bear market rally, because a bear market rally that keeps continuing is a bull market. So I think there were stocks before when the market was so pessimistic. I still remember a good breakout that was Elecon Engineering. So it has moved 60% since then. In this market, it's moved 60% without breaking even the 10 moving average, daily moving average. So there are strong setups out there which are performing well. I think some IPO setups like Paradeep Phosphates today broke out very heavily with huge volume. There were a lot of stocks that are breaking out. So you have to keep an open perspective without thinking whether it's a bear market, Fed rate hikes. In general, obviously there is some amount of this pessimism already priced in the market, because at I think 12,000 in the small cap index, people were so optimistic, but the market started telling you that something bad is going to happen. Way before the war was announced in Ukraine, about 10 days ago, the market was kept getting sold off, which means the market is responding before the event. It's not like the war. See, the war does not happen for one day, which means some people who have more information access than you have already known about the war, right? So then, same way, there could be a possibility for a better Fed decision, which some people already know, and that's why market is responding like this. FIs have been net buyers today, and I think even the last week they were net buyers. So, there is some change in perspective. So you need to keep an open mind without being too bearish. Yeah, you have to always keep exposure at only till 50% unless, we stand above the 50 moving average for some time, because I think it's just the first day or second day we have moved above the 50 moving average on mid cap and small cap indices. It's good to keep a perspective of trying to take about 30-40% exposure, testing waters, and then if you get profits, you can keep going. That's the way to go.
Brilliant, sir. Thank you so much for that. That was actually, I was gonna ask the strategy to deal with such markets, and you already covered that in the analysis. I do have more questions, and I'll ask you right after I ask breakout chart, sir. Sir, what is your analysis? आज का कैसा रहा? Breakout chart, sir, you were there with us day before yesterday as well, and थोड़ा सा हमने market overview लिया था आपसे. But today, जैसा कि अभी markets हैं, I think again there has been some critical junctures that have been crossed. So what do you think now, sir?
I think my views are known to everyone now. मैं हर बार एक ही चीज़ बोलता हूँ कि स्टॉक स्पेसिफिक बने रहिए. वी आई एम सॉरी फॉर द इनकन्वीनियंस, पर गाइस आज दोनों स्पीकर्स के नाम सेम है. सॉरी रोहित इफ यू डोंट माइंड, बट यस आज दोनों स्पीकर्स के नाम रोहित है. सो रोहित एंड मैं बहुत मतलब बोलते हैं ना मार्केट में बोलते हैं कि आपके दोस्त होते हैं, तो आई हैव ओनली फ्यू फ्रेंड्स एंड वी बीइंग वन ऑफ देम. सो हम लोग डिस्कस करते रहते हैं क्या हो रहा है. एंड रिसेंटली जो स्टॉक डिस्कशन है वो बहुत ज़्यादा बढ़ चुका है, बिकॉज द मल्टीपल सेटअप्स जो मिल रहे हैं मार्केट में, दैट हैज़ बी इंक्रीजिंग डे बाय डे. इंडेक्स ओवरऑल इज बुलिश. सो बी स्टॉक स्पेसिफिक इफ यू वांट टू. सेक्टर स्पेसिफिक आई डोंट फॉलो मच. सो बी स्टॉक स्पेसिफिक. बहुत स्टॉक्स में आज 20% सर्किट मारे हैं. प्रदीप का भी बोल रहे थे, तो प्रदीप ने बहुत अच्छा मूवमेंट दिया. बहुत सारे स्टॉक्स थे आज, एनडीटीवी 20% मूवमेंट दिया. सो काइंड ऑफ कूल्स ऑफ एवरीथिंग जो अभी तक हो रहा है. स्टॉक्स में बाइंग आ रही है, एफआईआईज बायर्स हैं. सो ओवरऑल अ पॉजिटिव आउटलुक. मेरे व्यूज़ सब सुनते हैं यहाँ पे हर हफ्ते में 2-3 बार. सो आज मैं भी एक स्पीकर कम और लिसनर ज़्यादा हूँ. सो आई वुड हैंड ओवर द माइक्स टू बोथ ऑफ देम. एंड एक छोटी सी रिक्वेस्ट फ्रॉम बोथ द गाइज, रोहित सर एंड वीवीवी. मैं थोड़ा सा एक छोटा सा इंट्रोडक्शन चाहता हूँ आप दोनों से, बिकॉज मेनी पीपल माइट नॉट नो योर बैकग्राउंड एंड योर एक्सपीरियंस इन मार्केट. सो अगर एक उस पर भी छोटा सा इफ यू बोथ कैन टच अप, सो दैट वुड बी अ ग्रेट थिंग.
Definitely, Rohit sir, Rohit Srivastava sir, आपसे maybe थोड़ा सा how about a background about how did you get to enter stock markets and how did you reach this place where you are? I mean, if you can share a little bit with us your history, that would be amazing, sir.
So I really got interested in financial markets in 1990, which is way back, and I would have been around 18 then in college. So it's a time that you're still thinking about what profession you want to choose, and I just got interested in the idea that you can make money in financial markets, and the approach had to be to figuring out how investing works. So it was not really an attempt to learn only technicals or charting, while that has become an important part of the model. It was really an attempt to learn everything there is to the markets, whether it's reading a balance sheet, whether it's looking at the economy, and then much later, of course, figuring out price movements through the use of charts. And what's really resulted in that journey is to have been able to come across models that work in combining all of these sciences together, which I think makes it far more interesting than being bound down by only one part of the science, and where you can connect the dots as to why something is happening or why it is not. And I think Elliott wave analysis, which became part of my toolbox between 1999 and 2000, just ahead of or right into the tech bubble, was probably a very important addition, because it makes the difference between being right 50% of the time to versus being right more like 70% of the time. That gap between, when you simply use indicators and you don't know when they'll work or not work, versus when you have an opinion, that I think that's the stark difference that Elliott wave analysis really made. It also helps you to connect the dots with all the other sciences, because it's a behavioral science, and everything that you do in markets is behavioral. Even fundamental analysis, for example, the way you grade stocks, whether you think they are in a growth phase, whether you think they're in a value phase, has very much to do with their behavioral traits, because stocks are in a value phase typically when nobody wants them, which means that sentiment is extremely negative. And that sort of fits with how wave analysis also looks at where you are in the long-term structure and price patterns. And so if you put all of those together, you can end up with models that work across the market science and makes it far more powerful. And that's how my approach has really honed itself over the years.
That is amazing, sir. Thank you so much for sharing that, sir. VV sir, thoda sa, if we can have your background as well, how did you enter markets and how did you get to be here where so many people follow you and learn from you?
So basically, when I started looking at the markets, when I was in 10th grade or 11th grade, I was looking at the markets. When my father used to look at the TV, financial news, I used to also sit next to him and watch. I was always, in a point of surprise where, these people, this panelists, come and find the target of stocks. I used to, wonder how targets are found in stock. I found it really interesting that, people could predict something and then, that happened. There were successful people there and a lot of panelists who I've also seen at those points. But then after a point of time, I realized that, following someone else and doing something doesn't work because, I was trying at a smaller size at that time. But, I realized after a point, when I was buying stocks that had already done huge moves like HEG or Phillips Carbon during the 2017 or, I think even those times. In the previous bull market, I had some experiences like, these stocks that had run up huge and that's covered by all the media as, the best stocks or even analysts giving you targets of 10,000, 15,000, but, they don't work. I was also a part of it. I bought them and, I lost some money out of it. So, that it was a long journey, but, there were some critical points where I found that, I'd already found that, things don't work. You can't become really successful if you follow others that do in financial markets. You'll have to have some kind of a hold to yourself or you need to know what you do before you do it. So then I started reading books from American authors like, Mark Minervini. There was William O'Neill's book, which had impacted me immensely. There were other books. I've read a lot of interviews, listened to interviews. I read the Market Wizard series. It's an amazing set of 4 books that could, give you a perfect example from about 40-50 traders, successful traders and investors. So then I understood that finally there was some rules, technically, which was important to do the complete process. There was something called charts. You have to do this, and you've got a framework of how to operate successfully because you're learning from somebody who has been successful in this career for a long time. So even though you might not be as good as them, but you cannot fail when you follow very sound and good principles of risk management. If you cut your losses at 7 to 8%, as William O'Neill says, you can't become bankrupt. Whatever hard you try, because at the good markets, you'll at least have 50% win rate, and if you cut at 7% loss, you're losing trades, and you let your winners run. You cannot lose. So there are some sound principles which I failed to follow in the beginning, which I learned through losing a lot of money, and then I understood some important things. So what I would say to anybody is to, try to read such books of successful people, get a hold of, how they've been successful. At least everybody talks about something called cut your losses short. And, you cannot make money during the first cycle of bull market. Not everybody can make money, though if you're lucky, you can. But, I was not that lucky. So I would just quote one line from, The Battle for Investment Survival of Gerard Loeb. He would say, nothing is more difficult, I truly believe, than consistently and fairly profiting in Wall Street. I know of nothing harder to learn. So he was one of the most successful stock market speculator from in the 1930s to 1960s. And still he says this is the hardest, profession. So the only thing is if you lose in your first cycle of your markets, it's highly probable that the money you've made during the bull run could be given back in a bear run. It's absolutely all right, unless your capital is protected to some extent. I think it always takes one more cycle for you to, make money and not lose but keep it. So, for that is where, risk management comes, because everybody can make money in a bull market because you buy it. The only way is up. But, you'll have to have sound principles. I think I issued a sell signal on 18th January 2022. When I found most of the leaders break down even though the market was holding up at all-time highs. Generally what happens is leaders stop before the general market and leaders bottom before the general market. So you can use, and if you ask me what are leaders are a group of stocks that have huge earnings and they have moved up 5 to 10x in the bull market and is now an institutional favorite. Like, most of the IT stocks, chemical stocks like Deepak Nitrite, Balaji Amines, or IT stocks like Mindtree, LTTS, LTI. There was a lot of these kind of stocks that was there. So when they top, it tells you the market is sooner or later going to top. So these are some critical points that I've learned.
Right. Thank you so much for sharing that, sir. Okay. So now getting back to the current situation and the markets, Rohit sir, आपसे I would want to ask. So you had a while back you had given a call when the market was about to hit bottom. You were one of the very early people who had given a call that the markets may rally from here. So I want to understand kind of your strategy, which we already got a hint of from what you told us about your background and how you came up to be who you are today. So we already got a hint of that, but can we maybe delve a little deeper into your process, your strategy, and your philosophy of investing and tracking the markets? So how do you track the markets, and what principles maybe you follow, indicators, strategies, whatever there is, sir?
So it's a pretty wide basket. I think if someone is really reading what I write on a day-to-day basis, he would get a better clue of what it is, because every day we are scanning different data points, trying to come up with what looks ideal. But to really model it, when we study Elliott wave analysis, it works very well when you combine it with sentiment. And sentiment can be measured in many different ways. You could either have a survey of traders, which is available for many global markets, not surely available for the Indian, but many other derivative data points which are now available, whether it's the participant-wise open interest, advanced decline ratios, put call ratios, all of these data points combined, you're looking at the index, discount, premium, and so on, can all tell you where you are with respect to previous highs and lows that have happened over time, and that can give you a sense of what the sentiment really is. And then when you combine that with Elliott wave analysis, you get a deeper sense of where you are in the entire fall. So when we are actually looking at the bottom of 15,001, 150 odd or 180, I think is the low that we made in June. What we were also looking at is a 5-wave decline from the high that we made in the early part of June. And when that happened, so the first thing that when you see a 5-wave decline is typically an Elliott wave analyst would start expecting a 3-wave bounce. The question becomes, what should be the size and scale of that bounce? And that is probably where sentiment analysis plays an important role. And so when we take a step back, and I can go into many data points, but one of the important ones that has probably highlighted a lot on Twitter as well was the positioning by FIIs. The positioning by FIIs was showing that they'd been short to around 135,000 contracts by the mid of May. That's the first fall occurred between April and May, and then the market sort of bounced back into late May, and then it started to fall again, and by mid of June you were at 145,000 contracts short. Now, while this was happening, you also ended up getting a similar reversal in what used to be a long position in the US S&P futures on the CFTC data, which is reported in the Commitment of Traders report every Friday. That reversed from being long to being short, and then short positions started to build up over the last 4 weeks, which by this current Friday, which is just a few days ago, had reached over 200,000 contracts. So there also short positions were building into the early stages of this bounce back. And in India also, the FIs continue to hold on to shorts, even though they had cut somewhat last week. They again edited back into last Friday's, Thursday, Friday sell-off, and it was back at around 108,000 contracts odd. So basically what we are looking at is, that, on every rise, people were willing to short the rise. And that was sort of indicative of the negative sentiment. And these short positions were also large. So see, when a market is falling, people are shorting is normal. But when it is abnormal is when the position becomes very large. So when we say 145,000 contracts, it's the highest since the pandemic, which was a reading of around 175,000 contracts in May of 2020. And same also for the US data point. It was the highest since then because we'd not really seen that sizable short position build up. So net you're looking at a rally that could develop on short covering, but that's just part of it. Now the other part which you have to figure out is, when you're getting such extreme data, and if it's comparable to a previous major bottom, are we already at a major bottom? And I think that's something that we'll have to figure out in the weeks ahead based on how it unfolds. So far, the structure of this bounce doesn't give us any indication that it is the start of a larger bullish trend, which is why the buys would still remain negative. Though I will add that it is pretty surprising to the extent that many stocks have held up their gains over the last 7 to 8 months, because so many months into, if we call this into a bear market, you would have seen much bigger cracks in individual stocks compared to any other previous bear market that you would have been through. And that sort of gives you a sense also that the Indian market is showing relative strength underlying in the stocks, even though you may feel there have been deep cuts in some stocks compared to the amount they went up. They're holding up pretty good. So that's I think the general analysis. But like I said, this bounce that we've seen from 15,180 till now still doesn't give us an impulsive structure, which is what we would typically look for a clear uptrend, and which is why it still creates doubts in the minds in terms of being able to continue very far.
Right. Perfect, sir. Perfectly. I mean, like you said, it was a very broad question and a very difficult one probably to model up and sum up. But I mean, that was a brilliant answer. Thank you so much for sharing all of that wealth of information, sir. So, if I may ask, in addition to this, how do you so how did you tweak your so depending on the analysis, like how markets are going to move, how did you tweak your strategy to deal with this from here on? Did you go out in cash, or did you I'm talking primarily from equity perspective. Like, did you how much of it did you go out in cash, or were you stock specific and still finding out breakouts maybe? And then from there on, also risk management perspective, if anything changed from maybe your stop losses were tighter than before, or something, any change in strategy related to equities, how did you manage that, sir?
My approach had been for long to remain bullish on this market, I think since the bottom that we had in 2020. And one of the reasons for that, and we called this very much the reflation trade. So when we called it the reflation trade, what we were really looking at is an environment in which the dollar was falling and prices of everything, including commodities, were going up. The hope, of course, was that the rising prices would not go so out of sync that it would cause significant central bank action. So I think that was our central view for most of this time period, which played out pretty well because that was the central theme of the markets on the way up. Now, the turning point for me was probably not January, when you did start seeing some weakening in stocks, because commodity prices were still holding on, even though the dollar had started to rise. Because the strength was still there in markets, we didn't really change our bullish stance till April of this year, which is essentially where, if you look at either the Nifty Metal Index or the Bloomberg Commodity Index peaked, and that was sort of the signal for me to back off a little bit. And back off meant that we did significant risk off, going to almost 70% cash at one point of time between April and May, just to avoid any potential downside risk that could occur in case it was significant. Right now, we are still not sure whether it will be significant or not. But given the extremes in data, like I've spoken about, we have gone back, adding to stocks, reducing the cash level down to only 30% now. So that's a significant exposure back in the market, just in case things play out. And if not, it would simply end up being a trade between 15,000 to 17,000, which we would probably close out of if the market loses steam or shows the signs of reversal that we are looking for. And probably we'll start looking at short side opportunities also if the market starts to fall. So that's how we are going to look at it. But we have raised our investment allocation over the last couple of weeks in light of this bounce back.
Perfect, sir. Brilliant. Thank you so much for sharing that with us, sir. Okay, VVV sir, you already kind of gave us a hint of how to deal with these markets in the very beginning with managing our exposure and in general tracking laggards and the leaders. But if we may delve a little deeper into it, how did you specially manage risk in this? And how did you deal with this regarding the correction side of that market that we just saw?
Yeah. So I had a lot of long positions since the start of the bull market. Like I was lucky enough to be, in most of the leaders, the chemicals and the IT, primarily because they were the first ones to break out in the 2020 after the 2020 COVID crash. So I was positioned in all these leading stocks, and I still remember that date. I think it was back in September. I think September or yeah, in those times when most of my leading stocks stopped, like Balaji, I mean Deepak Nitrate. A lot of IT stocks started showing those parabolic end moves, quick moves like 25% in 2 weeks, such kind of moves. That after a massive 300-400% move, if it does such a fast move, it clearly means that you're near the end. That's called the parabolic blow off end. Typically you can read that in most of the books. I think O'Neill speaks about it, David Ryan speaks about it. I think if you go to some of the US trading community, it's a very common thing, but people don't follow it because when in such days when things move 10-11% each day, you're full of adrenaline rush, you don't want to sell. But those are the best times to sell because after a 300-400% move, if you're moving 30-40-50% in a week, you have to be clear that it's getting too much extended and things are ending. So I came out of most of my leaders. Some I sold into strength, some I sold when they broke down, that parabolic move. So it depended on the size I had. If I had a lot of quantity, I sold some into strength and I tried to hold some still. Then I kept, I started to get a view that the leaders are topping. Most of the 2020 bull market leaders are topping, and the market is definitely going to go into at least a sideways consolidation, if not a bear market. So I reduced my exposure significantly from investment stocks right then, and I was only trading. Trading is basically some good VCP setups or maybe flat bases, that I was doing, and I was always managing risk. I still remember, 18 January 2022 when I closed even all my trading positions. There are two reasons. One was that I think I had 12 to 13 positions at that time, trading positions, and I think 11 trailing stop losses hit on the same day, meaning stocks were down 5 to 6%, and this trailing stop losses got hit. Your stocks are your first signal that something is wrong. If all your stocks, if you have a basket of 12 stocks and more than half is not performing or showing you violation signs, you have to be very clear that the market is going to top sooner or later. And most probably in a market like this, which was already sideways, you would also have generally having some. You would have some other leading stocks again, the other leading stocks, and when they all crack together, you know that something is wrong. And after that, 2 days later, we again broke the 21 EMA with huge volume, and it was already distributed. So after that, I had moved to cash on 18th, and I still had some investment positions which I closed when we moved below the 50 moving average on 24th January. So after that, I never traded significantly. I did trade in the March series, when the fertilizer prices was going towards the roof in the US. So the indexes also tried to form something like a double bottom. So I tried to play stocks like Excel, GNFC. I think I got 40-50% in most of these stocks. After that, we broke the 200 moving average, and I think I was done. I was not trading at all. I was just, posting every day that, cash is a position. So I think after that, I haven't traded much at all. I just tried a name or two, but they did not work, or I came out early. And it was just right now on 7th July 2022 that I started taking positions because we started forming a proper kind of a base, and we're every day market gets sold off. We get buying again at the end of the day, or maybe the next day morning. If we have a bad close today, we have a good opening tomorrow. Those things were the first signs that the selling has paused from the market and there is some buying coming in, and there was a lot of stock setups, and also the Nasdaq and the S&P was forming a beautiful base, forming higher lows. And when all together, and obviously we all fell because of the international issues. So if the international markets are doing well, you would probably do well. So it's just right now that I've started taking some positions in trying. Not all are working flawlessly, but yeah, I've up to at least 20-30% exposure. I was in 100% cash during most of the times, and one important rule I use is the small cap indices are about 21 exponential moving average, and that's a very good. I mean, I've backtested it for about since that small cap 100 was there. I think it was. I mean, it was liquid enough. I think it was something close to 2013 or 14, because before that the small cap 100 index was not that liquid in trade. Because of different reasons. So it's been a very good indicator for me. Below 21 moving average, there isn't much big moves that you're going to get. Yeah, stock specific could happen, but again, your odds are not in your favor. So this is basically how I managed this.
That's amazing, sir. Thank you so much for sharing that with us. This was a little bit about हम लोगों ने strategy सीखी सर से. So we are already getting quite a few questions. I had pinned a tweet on the space, and we are getting quite a few questions on that. I'll just start on those questions, but before we do that, I just want to ask one more question from my side. For both our speakers, maybe VV sir आपसे शुरू करते हैं. Are you seeing any sectoral headwinds changing? Any new sectors coming up on your radar which are gonna rally from here on?
See, I cannot say that the auto sector is a growth sector in general, because if you study history, you haven't. There were years when auto sector has done really well, but now the reason for the current rally in auto sector is that the chip shortage is getting over. Yeah, it could possibly be getting over, but again, positioning in large cap auto stocks I don't think could give you multi-bagger returns. But yeah, definitely there could be some these auto ancillary companies that are growing really fast. I think the bottom line for finding a multi-bagger is simple. You have to find stocks that are growing fast. If your industry is growing at 13-14%, you have to find stocks that are growing at 25-35% and capturing the market share. So in general, I'll give you another statistical perspective. Almost, I think, a lot of stocks before their massive price runs have had 40% or higher increase in their EPS in the latest quarter. This is a thing from the IBD, the William O'Neill's company, I think, through their research and in their books. So, the earnings will already be on the table before the big price moves start. So, looking at the charts are good, but I think you should also take some time in the weekends and go through stocks that have, in the latest quarter given excellent earnings. Earnings. That's what is going to drive your stocks. By Peter Lynch is definitely, not invalid. It's definitely valid. So when you look through both, you might get some stocks that are growing really fast and at, decent valuations. I would say that if your stock is growing at 40-50% in its earnings and, has a good ROC of 25-35%, if it's available at 25-30p, I think it's an amazing investment. And you could time it with your technical skills. You could buy a breakout, you could buy when it consolidates well. I mean, that's up to you how you want to accumulate a stock. But I think, there is a broad perspective. If a company is growing really fast and, it's available at a decent, valuations compared to its peers or, somewhere there, I think it's good to look at those companies also. They could offer a good entry in the coming days.
Brilliant, sir. Thank you so much for sharing that with us, sir. Rohit Srivastava, sir, if I may ask you the same question as well, do you see any sectoral headwinds changing? And from here on, like after every correction, there is a sectoral rotation. So do you see any headwinds there, sir?
See, one of the patterns, very, very long term, that I can probably share, which is an observation, is that we've seen around 8 to 10 years of phases in India where we get this broad-based economic participation, and then we have this tight period where you get very narrow sectoral participation, and this can sort of confuse us between which part of the market we should be in or not be in. So to give you an example, prior to the 1990s, there was a period where almost every sector did well. It really didn't matter which one you were in because everything was growing. But between 94 and 2000, you had a lot of the core economic sectors go into a disinflationary period. There was high credit in some parts of the market, and so a lot of it unwound. But the sectors that continued to do well were the defensive, FMCG, pharma, and then there was the tech sector, which was growing at that point of time. Now, rinse and repeat, the same thing happened between 2008 to 2020, where all the core economic sectors went into consolidation. You had FMCG, pharma do pretty well. You had the BFSI space do well, and so you had this narrow list of sectors that were outperforming versus many others that did not participate at all during that time period. One of the things that we've seen early stage in the last 2 years is that many of the sectors that were consolidating for almost the last decade started to break out of those patterns and have done rather well. So this includes all your core sectors, whether it's power, realty, PSUs, capital goods, and so on, which were all probably dead. So what usually would happen, my sense is that whenever the next bull market takes hold, whether it's now, whether it's a year later, that the core economic sectors are going to play an important role in the turnarounds. It just cannot happen without that. So that's one important part to keep in mind, because those are the ones where you're still getting value. But apart from that, I think the market also always shows up certain growth sectors or individual stocks that do well in the previous bull run and then continue to do very well in the following bull run. And so that allows us time to really look deeper into all the stocks that have done particularly well in the last couple of years. If they've had significant performance on the upside and they pull back, if those performances were driven by not too much deterioration in terms of their fundamentals or basic balance sheet not getting destroyed unnecessarily, and they're still small companies, then they might have room to grow a lot more. So that's one way of looking at it. One sector that I think will continue to be of interest to everyone simply because of the way the world is positioning itself away from the amount of oil they can consume is going to be the electrification theme. And I think that theme will continue to drive certain stocks and sectors, and one could probably continue to bet on those in the next cycle as well.
Brilliant, sir. Thank you so much for sharing that, sir. Okay, so we have quite a few questions. Let's start with थोड़े से audience से questions. Of course, they get primacy. I have a lot of questions, but as usual, we'll start with our audience questions for now. Okay, so first question is by Anish sir, and he wants to have your opinion on outlook on metal sector for both in short and long term perspective. So Rohit sir, VV sir, in case you are tracking or breakout charts of metal sector, if you're tracking, can we have your thoughts on it?
I think the metal sector is pretty oversold right now, due for definitely a rebound. But like I said earlier, what I'm not sure of is whether the rebound is the final bottom or not. It can look like that right now because you've had almost a 60% retracement in some of the stocks, including the ones like Vedanta, and you can see it in SAIL and so on. They've had pretty good deep retracements which are worthy of calling a good market bottom. But sometimes the market defies that, makes one more new low, and what would really drive that is underlying commodity prices. And what would drive that would be the dollar itself. So an important view that we would have to really take is whether the dollar has really peaked in terms of its long-term trajectory, which I don't think is a certainty yet. And so which is why I would probably take a trade on the metals over here, because like I said, they've reached very important low points, very oversold, but not sure whether it becomes the final turnaround point for them. Sometimes it can, because what can also happen is that you can end up getting what I call intermarket divergences, which is essentially that you get the first impulsive rally in the sector, and even if the dollar does run away, or you get another weakness, round of weakness in commodity prices, the metal sector does not really fall to a lower low. That also sometimes happens. It's hard to anticipate. Therefore, I think this is an important a point of entry, I would think, in the sector itself.
Right, right. Perfect, sir. Thank you so much for sharing all of that, sir. Okay. So next question देखते हैं. Okay, संदेश माने सर का क्वेश्चन आया है. वीवी सर, how do you shortlist the stocks? First fundamentals or first technicals? And is there a rule for you to bottle down on few stocks and then track them?
So, I mean, I do both. I mean, I run a scan which is 25% within 52-week high, which I run every weekend. I think you get nowadays there's only about 300 to 400 stocks that come up. Sometimes a little more than that, but at the best parts of the bull market, there used to be 1,000+ stocks that used to come in this list. It used to be a little bit hectic work. But then, that's something where you have to look whether there are some good entry points and, good the same chart patterns which is used everywhere. I'm not going to use anything, out of the box, but I do use some patterns that are something which I'm working on. Still, they're not, you can't say they're going to work perfectly, but I prefer everybody to, follow these standard chart patterns like, volatility contraction pattern or a good base breakout or cup with handle, flat base. These are things, that has been working for ages and, there's nothing new in the markets. History repeats itself. So, these patterns have been backtested by so many successful traders and, they're going to work. That's one section where you could trade. And I definitely, haven't still created a core portfolio, which I do in a bull market, but because, I haven't found any sectors that are, which I feel, see, there could be the auto sector could be a sector that could lead this. If so, bull market. I mean, we're still not sure whether it's a bull market at all first. So again, I don't feel auto sector could, do what the chemicals or the IT did. See, there's another perspective where I find some chemical companies, at great valuations, and it's a mega theme, they could still happen again. People say it cannot lead the next bull market, but I mean, it could not do the same massive runs. But I think, IT, chemicals, these are, evergreen sectors in my view, at least for India for the next few years due to China plus one, a lot of other macroeconomic policies that India allows, but the other countries are not allowing. So, chemicals, in fact, is something where, you don't get approvals easily. So, it's a very important sector that would drive, growth in India, I think, in the coming years. So that's something. And then again, another way of tracking is to follow companies that are growing at least 25% in their earnings and 25% in their sales every year. So keep a track of those companies, and then maybe you could track at what valuations they are, maybe by price to earnings or price to sales or EBITDA or EV to EBITDA. That you could find everything. I think, see, everything is going to give you the same results almost. I don't find it different, but make sure you don't buy stocks that are trading at 100 plus price to earnings. That's what people say that, in US, I accept that there are some high growth companies that grow at 200, 300% every year. So maybe 100% giving them 100 times price to earnings is reasonable. But I think in India, you have to, limit yourself to pay something for your company if you're going to do it as an investment. I think, anything more than 50 times their earnings is not, great to pay for a company because, again, the growth visibility in India is not as big as US. There are tech companies in US that were growing at about 100+% every year, and their sales is growing at 300, 400%. But I haven't seen much companies in India that do that. So, if you follow the price to earnings that has been, I've read books in, Mark Manavani's books or O'Neill's books. They say that, you could buy stocks that are up. I mean, which have price to earnings of 100, 200. But if you check their earnings, they were growing at way more than the price to earnings that the stock got. So, you have to keep a perspective of how much you can pay for an investment. So I think both of these you could do. And, if you get more traction that this is definitely a bull market, maybe because, all the indexes go above all the key moving averages and then you start trending higher. Maybe at that point, you could give a good allocation to your investment portfolio and reduce back on your trading because, sometimes sitting makes more money than trading because I've experienced this in the 2020 bull market. I could not have made what I made if I had kept trading. You have to sit, you have to buy tight and sit. And, the market's wave will automatically give you that massive return. So, for that, you need to get a lot of confirmation. You cannot be a bottom. I would like to tell one more quote, if you try to catch the first eighth and the last eighth, you could lose enough money to build a concrete highway across the continent. I think it was there in Jesse Livermore's book. So never try to bottom fish. The market is going to give you a lot of opportunities to buy. If it's going to be a bull market, it's not going to stay for 1 month, right? If it's going to be a bull market, it's going to stay for an year or two, or maybe at least 9 to 12 months again, just like the length of the previous bear market. So keep a calm state of mind. You're not going to miss anything. If a big bull market is coming and you're prepared to this extent, you are going to enjoy it definitely, without a doubt. So I think be calm, give some more time for things to be clear, and then take an entry. Don't jump in to be the first one. Trying to be the first one causes all the pain. So let some people confirm your view, let institutions start buying, let's see some big volumes in most of the stocks, let's see some sectors doing well, then you could definitely take a position. That's my
Brilliant, sir. Thank you so much for that. Okay. Next question, Rohit sir, आपके लिए है. So, as you already pointed out that the current bull run is corrective in nature and not impulsive, that begs the question on the resumption of downtrend. Will it be impulsive, and for how long, and to what level, maybe best or worst? So some of it I think we did address, but if you can have some views on this from you, sir.
So if the corrective bounce, as I'm calling it, does end in a corrective rise, the structure of the bear market so far has been complex, which means it's not an impulse is just one part of the leg. So any fall which is ABC, A is always impulsive, so is C. And so this whole fall is what we mark as ABC x ABC, to be a little more technical about it. And so that's how I think it will continue to unfold in a series of larger three-wave declines from wherever that is. And in terms of level, I think the downside is the downside potential, because of what we have done, say, on the monthly charts, which is we've broken the 20-month average. The monthly momentum indicators remain on the sell side. The lower end support is closer to around 14,200, 14,100, which is sort of a 38% maybe retracement of the entire rise. It's also close to the bottom that we made somewhere around April of 2021, from where the final upward rally actually took place. And so that, I think, could be an important support next to watch out for as and when we get the next sell-off.
Right. Perfect, sir. Thank you so much for that, sir. Okay, so we are getting a lot of questions, but we have limited time. So, audience, please help me out. Go to the tweet that is pinned on this space, like the questions that you like, and we'll try to cover them first. Okay. Till then, Ujjwal Agarwal sir ka question was on which sectors will outperform in the coming 1-2 years, that we have discussed in the podcast. For those who have joined late, we'll be releasing a recording of this podcast immediately after it's over. So if you've missed, in case you've missed any questions, please listen to the recording. Okay. Next question, Sachin Dubey sir ki hai, and his query is related to the crisis in Chinese house market. The fact that Chinese debt is one of the highest in the world, do you think that Chinese economy will slow down considerably? And what will be its impact on stock markets worldwide, considering China is the second largest economy? So, Rohit sir, you track a lot of factors. Is China a consideration for you right now? And this problem, how much do you think will impact this?
No, I don't think I've gone too deep into how the role of China.
Okay.
It's a very macro factor that has been around for, I think, too long. In fact, the observation I can only give is that Chinese has been through a troubled spot for many years. And despite all the rhetoric around it, I would think they are closer to the end than the beginning of it, though it may not appear that way, but you actually think about it. The Shanghai index, if I go by, peaked in 2008 and has really not gone beyond that all the way till now. So, and see, this is a very controlled market. So, I think government policy and their own interventions play a lot of role in terms of how their financials really behave. So I'm not too pessimistic on China, to broadly put it. I am rather more optimistic, given the long period of consolidation they've been through. But I'm not sure I can say beyond that.
Right. Thank you so much for sharing your views, sir. That's completely fine. Okay, next question. We have got a few likes on, so I'll go by in order of likes now. So Sanjay sir ka question is on hospitality stocks. And are they a good investment bet like Indian Hotels, Lemon Tree, EIH? So stock specific, we need not necessarily go into, but in general, your view on hospitality sector, sir.
I guess I am the only speaker right now.
Am I audible? Hello.
Yes, you are audible.
Okay. So VV sir ने भी शायद अभी just joined back here. Sir, are you there?
Yeah.
Rohit sir. Okay. So sir, hospitality sector में if you have any views. Another two sectors that we have got are packaging stocks and defense sector. So in case any of you is tracking any of these sectors, we'd love to have your thoughts on it.
In packaging sector, is because again it looks like it's generally a commodity sector. So you have to the growth is also the growth would definitely be there because of a lot of reasons, but the margins can contract. So that's my only thing I'm tracking. So not tracking the other two.
Right.
See,
Thank you, sir.
When it comes to defense and when it comes to hospitality, I think both. I don't know about packaging, but the other two definitely bullish right now because they're doing well. If you look at hospitality, I mean everything is packed. I think they've been raising rates in most of the sector, and the stocks have also held out. I think pretty well despite all the negativity in the market. So that's done well, and so has the defense sector simply given the greater spending in that area. So I think both of these sectors doing well. No signs of any breakdown on their charts, and therefore they remain bullish. I think medium to longer term.
Right. Thank you so much for that analysis, sir. Okay. Next, Bhargav sir had asked about is the bear market still over or are you still looking for last capitulation moves? So, Bhargav sir, we already discussed that. Maybe you can listen to the recording. Okay, so since we are towards the tail end of our podcast, this is a good question. I try to keep such questions towards the end so that we can kind of discuss them in a little more detail. So, Meet sir ka question hai, I have recently started my learning journey after facing many losses while trading on tips. Please share guidance on psychology and way to learn better. So I would love to have thoughts from all three of our speakers. So Rohit Srivastava sir, maybe aapse if we can start.
So it's this is one of the common concerns we get from people that we've lost money, now what should we do? And apparently most people who are saying we have lost money are not looking for education and are really looking for tips, which I don't think is a great solution. This is partly why at least my firm, which is India Charts, is really not an advisory firm. It's something that I've chosen not to do. That we'll do nothing that is none of the regulated business. I'm not going to manage anybody's money. I'm not going to give anybody advice. I'm not going to do anything of that nature. Simply because I came to the belief that if people can't help themselves, then nobody can really help them. And this may sound a little odd because there's an entire industry which is there to manage money out there, but my real question is, what are you really looking for from the market? If you're really looking at large returns, they do not come with limited risk. And so if you really try to limit your risk, which is what excessive diversification and many other strategies really do, then naturally your returns are going to come down. So that's a choice that you have to really make as to what you really want. Now, once you've decided that you're here in equity markets for a higher rate of return, then you're going to have to learn how to manage risk, which is basically an important learning curve for you. And therefore, simply trying to take tips from someone else is not going to solve the problem. Like the person has himself said that how do you deal with the behavioral aspects of the whole issue, which is what requires more addressing, because behavioral aspects also hurt you when you're taking advice from someone, because you might decide not to take the best advice exactly when you're supposed to take it, and in that sense it doesn't help either the advisor or you. So learning to be able to execute and manage risks is important. And like, just for example, he said that we end up buying the dips and completely getting it wrong. And if you actually study position sizing and trade management, you study turtle traders, you study any of these, and you'll understand that most of the active strategies are not really to buy the dip, but to buy the rise. They are exactly the opposite of what most people would really try to do. So if you use a handful of tools, even if they are technical tools, whether they're averages, whether they are trend line breakouts, and so on, what you would actually have as a system do is add to the position as and when increasing number of outcomes confirm them. So which means if I'm supposed to buy 100 rupees of stock, why would I buy 20 today and then buy 20 at a lower price and a lower price and a lower price, which is completely stupid. The whole point of investing 20 out of 100 is that taking a loss on 20 is much easier. And so if it's going against you, if things are not working out, why aren't you closing it out, taking the minimum loss on 20 of what you were going to buy in terms of 100 and walking away from it? And if it actually confirms by going in your favor, just imagine you bought 20 of something at 100, it goes to 110, 120, wherever it gives you the next confirmation. Say it's 110 and you bought another 20, your average is actually 105, which means your average is below the price, which makes it much more easier for you to handle that position, because unlike a situation where you buy at 100 and then you buy at 90, your average is 95 and the price is 90, which means you're anyway at a 5 rupees loss, which is psychologically hard to handle if it falls another 5 rupees. Whereas if you're bought something and the average is 105 and current market price is 110 and it drops 5 rupees, you're still at cost, and it's much more easier to handle that position and think about it than otherwise. So this sort of solves most of your problem. The only thing left then is to even execute that 20 part correctly. Not to average down a losing position, but to average up a winning position sort of solves 90% of your problems.
That's brilliant advice, sir. Thank you so much for sharing that with us. Okay, VV sir, if I may ask the same question to you, what advice do you have for us, for people who are just starting and have made losses based on tips, and how to deal with the psychology part of it?
So the first part, before you enter this business, is to first read somebody who's, read some sound rules of successful people. Either it could be people who are, breaking down by reading a lot of books and giving it to you, or but still, the best part is to read the books on your own. There are some handful of books which I could, or maybe tweet in the next few minutes after the meeting. But finally, it all comes up to how you deal the market. See, nobody can help you in the market. There is no other way than for yourself to sit down and put some hours, because if you got to be an engineer, you have to spend 4 years. If you have to be a doctor, you have to spend more than 5 years. So if you want to be, see, you could always call yourself a speculator, but you cannot become a successful speculator unless you sit down at your table and study how people have become successful in the field. How have doctors become successful? Is you learn it in a medical school, how doctors were successful, how some of these procedures have to be done. So similarly with an engineer, so the process of becoming successful in anything boils down to following what successful people did, or some sound rules that have been that has been helpful for a lot of people in the long run. So, and if you look at psychology of, if you've made a loss in the market, it's absolutely normal. Everybody starts off like that, and that's absolutely normal. So what I would suggest is to not think about it. If you come into the markets to recover your losses, you would never recover your losses. You could write this down. These are some things that have, many people have experienced this. If you come back into the market after a loss and try to recover the loss, you will not recover the loss. What you should instead do is to, focus on the process. Get a process for yourself. You could find it through, you could follow the process, any successful people. It could be a growth investment strategy. It could be a value investment strategy. I mean, I wouldn't prefer value because I don't find value investing the way it was told in Benjamin Graham's book, or the old kind of way doesn't work in the current markets. If something is cheap, uh, in the olden times, they say that this stock is not supposed to be cheap. But there was also, because of a lot of insider information and all these that was available at the past, which is not happening. The markets are getting efficient day by day. So you can't. I don't. I mean, see, I don't have a great experience with value investing. I've tried a few, I've studied a few, I've researched a few, but growth investing is something that works. Earnings pull the stock up, so you could trust on earnings. And if there's a trajectory, they don't end in a quarter or two; they go on for 10 to 15 quarters at minimum. So that's a strategy. Or you could be a trader. You could be a swing trader where you buy stocks on a breakout and you sell them when you get enough profits. So you could set a strategy for yourself. Study them hard. Don't just go through 3 examples and say, okay, fine, I'm done. Study at least 100 examples, 200 examples of how each stock broke out, how you would manage this trade. So that's going through the stocks and thinking what you would have done at every point through 100 stocks or 100 charts will give you a definite edge in your next stock purchase, because then that you've already gone through, you've like walked through how you could have managed a trade. Now you're definitely better than your previous yourself. You will be able to manage this trade better. And see, there are some things where you have to cut your losses short, small. If you let your losses grow big, you cannot make it big in the market. So the first primary rule is to cut your losses. And if you're getting 3, 4, 5 stop losses at a row, at a stretch, stop trading. That's the best way. You don't have to trade every day. I've done only 6 to 7 proper sized trades since this January. Just 6 to 7. I think it was Excel Industries, it was GNFC, it was I think some more of few of these names which I've tried. Some were successful, some were not, but the big sizes were only few, and I think this market only deserves that much of my money. So you have to be patient to not put in your money every day. And in simple words, when things are not working for you, see, and first thing is, don't look at others. If you open Twitter, there will be people who are successful every day. It could be surprising to you, and you could feel demotivated that how is this fellow successful on such a bad day? But it might be his day, his strategy is working. So you need not look at what other strategies are working. Just focus on your process of something that has worked in the past and is likely to work today. There are some timeless processes which work. So just focus on your process. In fact, I've in the recent interview, I even listened to David Ryan saying that he doesn't look at his P&L for the whole month. He only looks at his P&L at the end of the month. I think it was not now, but in the past. But these kind of things where you only focus on the process and not on the result is something great. And your process should definitely have something like stopping to trade after you lose in 3 to 4 consecutive trades or something like that. That is something to be defined in the process. So I think that's the key. That's the key.
Right. Thank you so much for sharing. That's again a brilliant piece of advice. Thank you so much for all of that. ब्रेकआउट चार्ट सर, आप भी प्लीज, आई वुड लव टू नो योर व्यूज ऑन, आपने पहले भी हमने आपसे ये सीखा है, बट वंस अगेन आई एम श्योर देयर आर न्यू पीपल इन द ऑडियंस वुड लव टू नो योर टेक ऑन इट एज वेल.
रोहित सर एंड वीवीवी हैज डिफाइंड इट प्रीटी वेल. मैं बस सबको ना अ लिटिल एडवाइस, एक बहुत छोटी सी एडवाइस, इफ यू डोंट वांट टू रीड एंड इफ यू डोंट वांट टू मेक अ प्रोसेस, डोंट डू इट. That's fine. But the only request I would do to everyone is sit on the screen from 9:15 to 3:30 and keep watching random stocks. If you can watch TV channels, you can watch those stocks. Any stock you can be live on Twitter on entire day. Many traders shares they trade on live basis. So keep analyzing their charts and do it in your way. उससे क्या होगा ना, आपको समझ, भले आपको बुक नहीं पढ़नी हो, भले आपको नया खुद का सिस्टम नहीं बनाना हो, आप स्क्रीन के सामने बैठे रहेंगे ना, सो आपको कुछ ना कुछ अपने आप समझेगा कि यार ये यहाँ से क्यों रिवर्स हुआ, ये यहाँ पे टॉप क्यों बना. सो दैट वुड बी अ थिंग. मैं आई हैव बीन ट्राइंग दिस इन द सेम थिंग इन बैंक निफ्टी फॉर लाइक 4-5 months नाउ. आई हैव वॉच बैंक निफ्टी फॉर एंटायर डे. मैं कुछ नहीं करता, मैं देखता रहता हूँ बैंक निफ्टी को कि बैंक निफ्टी कर क्या रहा है. and over a period of time I have a sense of feeling कि ऐसा होता है तो market ऊपर जाता है, ऐसा होता है तो market नीचे आता है. So this is a very 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 small thing जो many people try to avoid कि full time trader बनना चाहते हैं या market में अच्छा करना चाहते हैं, but पूरे time screen पे नहीं बैठते. That is a big no. If you want to be successful, you will have to give your time. If you don't want to read books, that is fine. If you don't want to develop a system by reading someone else, that is also fine. But be on screen for entire time, and I, I assure you that कि 100 क्या 200% you will be able to make a system without any help. थोड़ा time लग सकता है, but you will be able to develop it. Every one of us out here have done it in the same way. किसी ने थोड़ा पढ़ा होगा, किसी ने losses खाए होंगे, but it takes time, but you will be able to develop your process. So be on screen for the entire day. You will have beautiful results in 2 or 3 months. So छोटी सी request है, जो full time screen पे नहीं बैठते हैं, कल से screen पे बैठना शुरू कर दें.
सर आई थिंक आपकी जो एडवाइस है ना दैट इज दी वेरी ओरिजिनल पीस ऑफ एडवाइस जिससे कि ये सब शुरू हुआ था. आई थिंक रेमिनिसेंसेस ऑफ स्टॉक ऑपरेटर एडविन लेफ्री की वीवी सर ने मेंशन किया भी था उसको आई थिंक बीच में पॉडकास्ट में. And the book starts with what you just said. He was actually the main protagonist of that book. He was a stock guy जो कि वहां पे बैठ के बस numbers stickers change करता था. So and then he would see patterns in those numbers, but just he had no idea कि वो prices हैं कुछ हैं. He would just enjoy those numbers, and from there on he would start predicting his model kind of developed. So thanks for sharing that, sir. With this, I think आज का हमारा podcast is already a little longer than usual, and we've gone for over 75 minutes, and we still have over 700 people listening to us. It's all kudos to the brilliant speakers that we have had tonight. Thank you so much, Rohit Srivastav sir, for making out time for us. Thank you so much, VV sir, for making out time for us. Breakout chat sir, as usual, आप तो हमारे general co-host हो ही हो. I really can't thank our guests tonight. They have shared brilliant pieces of advices, and our beautiful audience tonight. Thank you for your patience, being with us all throughout. And I would request all our guests tonight, please, please, please do allow us to host you again and learn more from you.
And before we end, एक छोटी सी request for VVV. If possible, do share a tweet by for all the books you read, all the books you recommend to read. So that would be helpful for me as well and other people as well.
Definitely.
Okay, sure. Thank you. Okay.